what's actually very surprising to me is, I said before, that gold really shouldn't be at new all-time highs with the money supply falling. And the fact that it is means that there's a lot of strength here, and or a lot of weakness in currencies, and just wait to see what wait what happens when the Fed really does turn around. I think you're going to see gold going up by hundreds of dollars a day, silver going up by $3, $4, $5 a day. And that's really going to panic the central banks. They're not going to know what to do. They're not going to really be able to do anything, because they'll have to choose between saving their currencies and saving their banking systems. A banking system can't survive with a currency that isn't worth anything, and a currency can't survive with a banking system where they just keep printing more money. So, and the only thing that's going to be left is gold and silver anyway. And then we can restart a monetary system based on that after a lot of chaos. Don't ask me exactly how that works out. There's going to be a lot of problems. And the internet might go down in the meantime, maybe not, we'll see. But that's what we're waiting for. That's the end game. And it means that gold and silver are no longer exchangeable for currencies, and that's what we're waiting for. A lot of people point to central banks. They say they're buying gold, and they're buying gold at rates that are records since the 1950s. That's true, they are. But if you look at the net holdings of gold by central banks since the 1950s, they haven't moved at all, right? They were up in the 1950s, and then they kept selling and selling and selling until around 2000, with gold at a low, and then they started buying again. So central banks own about the same amount of gold they did 70 years ago, but they have a lot more a lot more currencies, a lot more fake money on their balance sheets. So this has to even out by the values of those fake currencies evening out to gold. And a lot of times what you see when this happens in a hyperinflationary country is that the central bank just lops off 3 zeros from the currency, and then they start over. So that could easily happen if, let's say, gold moves to $35,000 an ounce, and then the banking system collapses. You could see a reset at okay, so let's say, well, the dollar is now 35,000, and now we're going to go to 35 again and start over from 1971. We'll call it the new dollar, right? That's exactly what Weimar did when they restarted a currency in 1923. They called it the Rentenmark, and I think it was like backed by land, which was backed by gold. There was some kind of scheme there. How many zeros are going to be lopped off? I don't know. I think it's going to be closer to 3 than 12, but who knows? I was looking at a long-term chart of silver. First, I was looking at 5 years, and I drew a triangle. And then I was looking all the way back to 2011, and I drew a triangle there. A triangle means like the uptrend is going down and the bottom trend is going up, and it's meeting at a point, which means the price between bulls and bears is getting more intense. And then I looked like at a 90-year chart. Yeah, that's what I said. It was a 90-year triangle. Right, going back to 1933 when silver was 25 cents an ounce. So I saw the triangle goes all the way back to there. Right, 1933 is really, we talk about a reset a lot in these days. 1933 was a reset, and that was a currency reset from $21 an ounce to 35. So that's really when this current inflationary pyramid began in 1933, 34. Right, when the entire gold supply was just pilfered by the government and given to the central bank. So is it surprising that the silver triangle has been playing itself out since then? Well, yeah, it's kind of it's breathtaking, but it's not surprising if you think about it logically. I mean, because silver is the money and the dollar is the derivative. So that once that triangle breaks out, that could also be, from a technical standpoint, be the end game. But technicals and fundamentals, that they eventually meet. They're on the same page. Not always. There's, we know that fundamentals and technicals don't always match, but in the end, they always do. Don't rely on ETFs. Don't rely on futures contracts. Don't try to make a profit in currency terms using gold and silver. You can, if you like that game, play it. I mean, if you enjoy it, but don't count on dollar profits or pound profits or currency profits to save you from an end game. You'll need physical, because when the currencies go, there's going to be nothing else to spend except the actual coins in your pocket for a while. And then after that, they'll figure out a new currency system. That's going to take some time. In the meantime, you need to live and survive. And you'll be able to buy a lot with physical. So the first thing you need to do is get physical silver, and then some physical gold for what I say is physical silver for during the end game, and physical gold for after, because gold will be more stable, though silver will be more important when there's no money that works. With the way that that Keynesian economic structures an economy, when you print money, things seem like they're doing better. And though money isn't being printed right now, there's still more money coming in from the printing of 2020 and 2021, which is keeping the banking system from completely collapsing. But we already saw back in March that it started to collapse, and it's going to get much worse until the Fed starts printing money again. And when they do, that might be it for currencies, because they're going to have to print, what was it last time? It was like $4 trillion in a few weeks, or 2 or 3 trillion. I lose count, but and so this time it's going to have to be more, because when more financial institutions have more money, they lend that money out. When you print money, they lend the money out and they go into debt more. So they need more money to pay back their own debt. You need to print more. And that's why everything goes on an exponential curve in this monetary system. And we're about to head to the vertical portion of that. Any month now, it could be any week now. Can't give an exact time, but I'm pretty sure it's going to be in 2024. That much I can say confidently. And I could even be wrong about that. I've been wrong before, but I'm pretty confident about 2024. I was talking about reverse repos until a few days ago, when I started paying attention to the repo markets, which is the reverse of reverse repo. Basically, repo is when a bank exchanges treasuries or government securities or whatever country you're in for cash that they need to settle the day. A reverse repo is when a bank has extra cash and they have no one to give it to, so they give it to the central bank in exchange for treasuries, so they can settle the day with less cash, because it costs money to hold cash and it costs less money to hold treasuries. So from around 2021, late 2021 to now, there have been no repos, meaning no repos directly with the central bank. There have been repos between banks, but the central bank hasn't been involved, because some banks have extra cash that they can lend to other banks that have not enough cash. There is this phenomenon that there is increased liquidity in the system right now, which means increased reserves. And the question is, so if it's tight in the repo market, but banks are holding on to this excess liquidity, they don't want to let go of it. Why are they doing that? And I think it was Mark Cabana of Bank of America, who's one of the head bond guys in Bank of America, like really happy. He's in the news a lot. And he says, why is there extra liquidity? He says because that banks are holding on to it, because if there is a liquidity crunch and then people start withdrawing cash or taking money out of the banks some other way, then banks would have to sell assets in order to meet those redemptions. And there's the unrealized losses on bond portfolios for banks, which is what brought the regional banks down. I think they're like $500 billion across the banking system. So if a bank that has unrealized losses on its bond portfolio is forced to sell to meet withdrawal requests, then those unrealized losses become realized losses.